The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hi, I'm Esther Gulius, the tax lady from EG Tax. This is Ask the Tax Lady. And occasionally, we, instead of answering your live phone calls in studio, what we do is we have a show just kind of chewing up the emails that we get. And that's what this show is going to be. So if you had your finger on the dialer and you were going to call in, you're going to have to wait till next week. We're going to just do our emails. And, of course, I got two of my right-hand people. I got two right-hand people here in studio. That's Tiffany Fabian. Hey, Tiff.
Hey there, Esther. How you doing?
Good. And Mr. Fabian, Christopher.
Hello, Esther.
Hello, Christopher. So here we are. In the middle of the year, and we're doing some tax planning, looking at these emails. What do you got, Tiff, to start off?
I've got Ryan from Williamsville. Esther, I've been paying child support for the last 2 years, and I was wondering if there was any deduction that I can take for the child support that I've paid. I don't have to tell you after I pay my bills each month, I don't have much money left. Is there anything that I can do? It's really tight.
Well, it may be that you would qualify on the state of New York if it's paid through the New York State Collection Unit and it's payroll deducted, that you and you would have qualified for the earned income credit, that you would get a non-custodial earned income credit on the state of New York.
Yep. Now the money that you pay has to come from a support unit, so that means the money that you pay for your child support has to come right out of your paycheck or out of an established account that New York State deems appropriate. And then you also can't be behind in your child support. That's also another caveat. And then also, don't forget, if you're a divorced person and the divorce decree says that you are eligible to claim certain children, that you follow up and do that and make sure that you claim the kids that, according to the divorce decree, even though you're not the custodial parent, you can claim.
Right?
Right. And if it was a divorce from 2010 going forward, you need the 8332.
Really
so
signed.
So you got to be nice to the ex.
Right.
So she can, because if she normally it's the she,
right,
if she doesn't sign it, then you can't claim the children.
Right.
Unfortunately.
Right. Unless it's through the New York State Collection.
No, you can't claim the children unless there's an 8332.
No, I'm talking about
the non-custodial EIC. Right, that you can do.
Right.
But claiming the children, which with the new tax law is a $2,000 credit on the federal return.
And and here's, I know I had a divorce in my life myself. It's very difficult in divorce situations to be able to have any kind of sobriety between people, especially when they're mad at each other. But I will tell you, if there were a chance for the two of you to sit down together with a tax advisor, and you kind of thought about your taxes as a pot of money, and the two of you could say, well, if it goes in this pot, this is how much the refunds are. If it goes into this pot, this is how much the refunds are. And maybe the two of you could end up splitting some of the increase because of the pot that the refunds are ending up in. Because we have that $2,000 credit, but we have a $1,400 inside that $2,000 credit per child. We have a $1,400 refundable portion.
Good
so
point.
If you have a mom that maybe is lower income, she might get the earned income credit, but she's not going to get that refundable feature. Yep. So it really has to do with how the family unit or former family unit can do better.
That's right. And you have to approach it like that. Esther, I got a question here. It says, I hurt myself at work, and currently I'm on workman's comp. I know that the taxes are free. What about the settlement they are offering? It's almost 7 digits.
Yeah, well, workers' comp is tax-free.
Right, but
what you're going to find out is that there's going to be repayment to Social Security and all that kind of stuff if you do the settlement. So.
And if you get repayment of Social Security, you used to be able to take it as an itemized deduction on the federal return, but now you can't any longer.
You can't even take it on New York State because it's tax-free.
Right.
But I'm thinking of the 1231. You never pay tax on the money using the special payment credit, we'll say.
You mean, yes, right.
Right. But, one thing, and I know talking to a lot of my clients, you got to be careful with taking settlements. Yet tax-free, this is something beyond taxes. Once you take that settlement, workman's comp is done.
Right.
So if you have a lingering medical issue, and they used to pay it, they're not going to pay your medical bills anymore. So if you still need backs, which this is probably big, if that's that big of a settlement, if that's, you're going to need back surgery, you're going to need, major care going forward, you may not want to take that settlement because that $1 million could be eaten up so fast with medical bills.
Well, and many times, and I know, for instance, the state of New York, many times on a workers' comp settlement, what they do is they first issue that W-2 with it being taxable, and then they get the settlement. Then they do they give you a corrected W-2. Sometimes it's 2 or 3 years back, so you have to amend those tax returns to put them in. Because when you get that workers' comp settlement, there's everybody going to be at the water trough saying, "Oh, they owe us money. Oh, they owe us money," and you get what's left.
Yep.
So Chris is giving a good advice. Talk to your attorney.
Right.
That's right.
Who probably wants
who's probably charging $150 an hour to look at But read. I mean, that's anything. Read. If you want to, if you want us to read we talked about divorces. If you want us to go over your divorce decree with you before you sign it, to go over the tax implications, we can do that.
Right.
Come before anything happens. Do that tax planning before, because after it's almost too late.
Yeah, it is too late. Okay, what else we got?
Cameron from Buffalo writes, EG Tax, I have some money in the bank in Fort Erie, Canada. It's approximately $75,000 Canadian. Someone told me I have to file a Canadian return. Is that right? He has to do an FBAR. I know that's right.
Well, for sure, you got to do an FBAR. And an FBAR is a financial bureau.
I call financial bank. Foreign bank account reconciliation is what I call it.
So if you are a U.S. citizen with income in any non-United States country, which exceeds $10,000 or more, you have to do this FBAR report. If you don't do the FBAR report, it's a possible $10,000 fine or half of the value of the account.
Gulp.
It's a simple form to do, but you have to do it. And you have to do it for each year that you have over $10,000 in that foreign bank account. So I don't know if he's going to have to file a Canadian return. I doubt it because there's not that much interest. But certainly he has to do an FBAR.
Yep, absolutely. And then I know this year, Chris and I had a tax return for a dual citizen, and he resides in Canada. He makes all of his money in Canada, but he's part of a business, and he has shares of a business in Canada. And so, Chris, will you explain what you had to do?
There's another form you have to do. If you're a shareholder of a corporation, on the board of directors of a corporation, you have to do a 5197 on your personal return to say, hey, I'm invested in this company. It's not I have money, I'm invested. I have an investment. But going back to this question, with having over 75,000, he has to actually do a Form 8938, attach that to the tax return, and do the FBAR. Now, this is stupid. It's the same information. My money's at Toronto Dominion. Here's the account number. So you put it on the tax return, then you got to do the FBAR. Toronto Dominion, account number, how much money.
Right.
So you got to do it twice.
Okay, I'm Esther Gulias, the Tax Lady. We're going to take a short break, and we'll be back on the other side with your emails. Hi, I'm Esther Gillies, the tax lady from EG Tax, and today we're doing your emails rather than taking live phone calls. So, and again, if you would like to be featured as one of our email people, you can email us through our website at egtax.com, Ask the Tax Lady, and listen in one of these Saturdays. We do 2 or 3 shows like this a year. You might find out that we're answering your question. And speaking of that, I got Tiffany Fabian and Christopher Fabian in studio with me, my right-hand guys. And so what do we got?
Connie writes in, my mother is not able to live on her own anymore. She has moved into my house. Can I use her as a dependent? She only has Social Security to live on, and it's pretty small.
Well, it sounds like possibly.
Yep.
Because even though if her mom has no taxable income, she passes that test regarding dependency. The question would then be, does
Support.
Connie give over 50% of her mother's support? And I'll tell you, that's a really good thing to do, is to come in and we'll do a support test, because if mom saves the money, like let's say when you do the support test, you find out that mom is giving $1,000 more towards her support than Connie is. Well, then mom should save the $1,000 in a bank account so that Connie would be able to claim her mom, right? Because
Absolutely.
if the money it goes away in gifts or goes away into a bank account, then that won't be held against her in a support item, and that's where tax planning comes in to play. Is this important to Connie? You're darn tootin', because then she gets, I'm assuming she's single.
Yep, she would get head of household.
She gets head of the household.
Absolutely.
Yeah.
And that's where tax planning is so
18,000.
important. Chris, you were
I'm
going
going to throw a monkey wrench into
Naturally.
this. I know, but it's me. Come on, would you expect anything else? If Connie, though, has insurance through the marketplace,
Oh, that's different.
right? I mean, but this is now health insurance is part of tax law.
But of course, there's no penalties.
There's
year.
no penalties.
Right.
But if you're claiming mom's income goes against you when you do the 8962.
Right. That's
So if you did the beginning of the year saying I only make $35,000 and mom makes $12,000 in Social Security, your now income is at $47,000.
So-
That's going to change your subsidy. So the
Amen.
money you're going to save by claiming mom
may not be
may
in
not
your
be a
best interest.
savings at
Right.
all.
That's correct.
So-
but assuming that Connie has health insurance
Through
through her
her
employer,
employer.
then it would be a savings. You see how complicated it gets? It's like right hand, left hand, up, down, and it really depends on your situation. And there are so many complexities built into the tax code, and there's so many areas that overlap, like health insurance overlaps with dependency. That's why you really need to sit down. And what do we charge to do consultation?
Zippo.
Nothing,
Nada.
right?
Nothing.
Nothing.
We really charge nothing. And we just want to establish a relationship with you, because we feel like if ever you do need professional tax help, you'll give EG Tax a call, right?
Right.
That's
All
right.
right, what do we got?
Larry from Depew says, Esther, we have these rental properties we own, 10 of them. They're all paid off and we're giving us a nice cash flow, but I'm tired of the bother. I bought them over 25 years ago for a song when Buffalo properties weren't doing so well. Right now, I think they're worth $1.5 million. What if I sell them? How bad can I get hurt? Yikes.
Well,
that's a lot of capital
I think
gains.
he needs to go see Mr. Gullo.
Right.
So I guess what the first thing Larry needs to do is just determine, does he want to get out of rental property altogether?
That's
Right?
right.
Because if he says, yes, I want to have nothing to do, I just want the cash in the bank, then he needs to understand he's going to part with a lot of cash to sell them. So when he sells, if he sold them outright, there's going to be X amount of dollars he's going to have to pay in taxes. And off the top of my head, if it's 20% of 1.5 million, it's about $300,000 there and abouts, right?
Jeez,
Because
that's a
with
lot
the
of
state
money.
of New York, because state of New York has no special treatment. Or he can hold the mortgage.
Yep.
Right.
Right? So if he holds the mortgage on the 1.5 million, then the percentage of gain that's taxable, and it looks like it'll be close to 100% because he had them for so many years, is going to be taxable in little increments plus the interest. So it's a little, instead of paying the $300,000 up front, he'll pay a little bit a year over the life of the installment. Or if he wants to stay invested in property, but he just doesn't like the way that he doesn't like 10 and he wants to go into 1, he could do an exchange, right?
That's
Right.
right. That's right. Yeah, one of my clients this year held the mortgage and on one of her rentals, and it was far, obviously, better a tax situation than had she sold it outright. So
Right.
the options are as you presented.
And so if you are somebody that's thinking about doing an exchange, you can exchange it for property, one big unit here, multiple unit here. You can exchange it for a partnership in like maybe a Family Dollar that Russ Gallo could put you into. You can exchange it for, 1.5 million. That would be about one rental property in Florida. I mean, there's all kinds of things that you can do, and you wouldn't pay the taxes.
Right. I mean, and part of the thing is, what you brought up Florida, is say I'm going to retire down in Florida in about 8 years. You can take your rental properties now, exchange it for a rental property in Florida for those 8 years. Then you move down there
And move in.
and you still don't pay tax. It
Amen.
reduced your basis.
It's remarkable.
Right.
defer.
So this is what's so important. Talking and figuring out what you want to do, that is like so cool. Because I will tell you, 1.5 million would be one house in Florida. So if you had a rental in Florida, you'd get some great rents in that one house until you take over. And then when you get down there, move in it. And even though it's now personal, you've already legally deferred the gain.
Right. Right. So, and I think if I remember correctly, talking to Russ, it's 2 years. You have to have it rented for 2 years.
And then think
Not
about
bad.
it. So you would have paid over $300,000 in taxes on the federal. You do the exchange. You exchange it for one lovely house in Florida. You rent it for 8 years, and then you move in. All right. And then when you die, your basis is basically zero in Florida, right?
Right.
So then when you die, what happens?
Your
Stepped up.
beneficiaries get
Get
it
it.
as the stepped up basis.
And
So
they
now
wouldn't
if
have
it's
to pay
worth
taxes
$2
at all.
million,
Right.
they sell it and they now have $2 million tax free.
Free.
It's called defer.
Plus, plus, you don't have to pay New York state tax.
That's
Because
right,
you've moved to
it went
Florida.
So that just saved you $80,000.
Right. So, I mean, can you hear? This is what I love about emails, because you get to really
Yeah.
chew it up. So,
And that's what I tell
if you're
people.
thinking about retirement, or you have rental property, or any situation, stop in, make an appointment, call us at 632-7886, and we're happy to help you. There's no charge.
Right,
We
I
just wanna
love
help you.
doing the face-to-face consultations because you blow these people's mind away with tax savings, and they're like, well, why wouldn't this person tell me that? Why would because
But again, you have
this
to do
is-
it in advance.
Right.
Yeah.
But this is what we do for a living. We do taxes. We don't do investments. We don't do exchanges. We don't
sell anything.
we don't sell anything. We
But our
help
service.
you.
Right. That's for sure. Okay, what do we got here?
I got Tony from the Pew. EG Tax. I'm just getting started in a small business. What do I need to do to make it legal? I have a helper who I use as a self-employed person, and I give him a 1099. I have liability insurance. Do you have any other suggestions? Do I need to stop in and see you?
Yes.
So that's Tony.
Yeah.
And so
well, first of all, his helper on the 1099 right away is a potential red flag, right? Why?
because it sounds like he might be an employee,
Aha.
and so not a self-employed contract worker, but an employee. If he tells him when to come, when to go, what to do,
How to pay
where to
him,
go, the tools
provides
to
the
do it,
tools.
then he would be an employee. And so you really want to make sure that you're doing things right, because heaven forbid he's hurt on the job.
Or New York State Department of Labor stops in.
Yes,
Right?
yep.
They could just make your life not happy.
Right. And so another thing that he might want to do is he might want to incorporate.
Just to show
Linger.
people about how the New York State, we use an outside payroll service to pay our
we do.
our
Staff.
payroll, right? So a number of years ago, this outside payroll service, and I won't say who it is, made a glitch in filing a New York
Report.
actually federal in New York 45. So we got it all straightened out, and they got it all straightened out with the federal. We just during tax season got a penalty of $6,500.
Oh my God.
On that thing, and thank God Maria, our district manager, was able to get it corrected.
Oh, my
but
God.
somebody else that would have gotten a $6,500 penalty might not know what to do. Messing around with the New York State Department of Labor is not a good thing to do.
Oh no.
No,
Oh
no.
no.
It's-
So that's why Tony needs to stop in and see us, because there are a lot of things you want to do to get yourself set up legally and ethically and correctly as a business, so none of these agencies can come and cause you a problem.
And I think incorporating would be a really good idea for him because, of course, if you incorporate, then if anything, God forbid, would happen while he's on the job to somebody, a client or a customer, they could go after his personal assets. So incorporating is a really good idea.
Right, right. And he might want to check with New York State sales tax.
True.
You know,
Very
not just
good.
the Department of Labor,
That's
but the
true.
Department of
That
Sales
all
Tax.
of them got big teeth.
Yep.
These
yep.
are all alligators down in Albany that would really like your money. So you want to make sure you comply.
Yep, because-
compliance is very important.
Right. There's 2 taxes out there that they will shut you down for not paying. Income tax is not one of them.
Yeah.
It's payroll tax and sales tax.
Correct,
Wait,
correct.
those are both New York items.
Yep. That's right. So
Because-
you want to make sure you get all your I's dotted and your T's crossed, and EG Tax will help you with that. We have a bookkeeping service as well. If you aren't very good at keeping track of your books, and we'll be very happy to help you with that. I'm Esther Gullius, the tax lady from EG Tax. We're chewing up your emails today. Next week, we'll be back with your live phone-ins. We're going to take a short break for the news, and we'll be back. Hi, I'm Esther Gullius, the tax lady from EG Tax. This is our email session where we're chewing up your emails. I got Tiffany Fabian, Christopher Fabian in studio, and we're dealing with your emails. Of course, anytime you can hear us, we really would like to help. You can call us for an appointment, complimentary appointment at 632-7886. You can go to our website at egtax.com, ask the tax lady. We will answer your questions. The bottom line, if you've been listening, do it before tax time. Do it before retirement. Do it before you sell the property. Do it before you gift the property. Do it before somebody passes away. All those things are so important because once the die is cast, there's not much you can do. Am I right?
Right.
Too late.
Okay, we got another. We got another.
Joan. My son is moving to Vietnam to teach English. His recruiting company said his income will be tax-free to the U.S. Does he still have to file?
Yes. You have to.
That was unanimous.
You have to report worldwide income. So even if you work,
Now there is a foreign income exclusion, right?
Right.
So that he could utilize part of that as tax-free income. But in order to do it, you have to do the exclusion.
Right, which is a 2555.
Right.
And there's yeah. A lot of information on that form. But you put it on and you put it in line 7 and then you take it off using the 2555. I was going to say on line 21. But he probably, as long as he's making under $105,000 a year, he'll pay no tax to the federal government. But even if he did make over $105,000, say he made, maybe he's an executive somewhere and he's making $200,000, he can use the 2555 to offset the first $105,000, then use the 1116 for the tax he paid to the other
foreign
country.
taxes, right.
So he may end up still paying no tax, but you
But
still
he's got
have
a
to
couple
file.
of hoops to jump through.
Right.
Yep, that's right.
But if you don't file the tax return and they get a copy of the W-2, they will send you a bill.
That's right.
Right?
That's
Yep.
right. So you'll want to make sure you do it in advance correctly. It's always a good idea.
Okay, what else we got?
I got Alex. Esther, my dad passed away in 2017, and I received his life insurance from his savings checking account in January of 18. Now I was sent a check from his IRA, but it's made payable to the estate of Nicholas to me. Is it to me? What do I do? I'm confused. Alex.
Okay, well, it sounds like the estate was opened. He's got to do. He's got an estate return.
It sounds like Dad didn't have beneficiaries,
That's for sure.
which is
That's
could be a big.
But number one, when you get something made out to the estate of, that's the clue. That means that that's money that is payable because the person who passed away left income on the table, and they sent it to the estate of. And if the estate is more than $600, you have to do an estate return,
And what
1041.
Chris said is so true. It's so sad because estates are taxed at a much higher rate. So now they're going to have to do an estate return. I did this for somebody this year, and they were like crying in my office. They thought they weren't going to owe anything. And we had to do an estate return, and they owed in excess of $10,000. And he was
But of course, if it was distributed, then you would do K1s and you give it to the heirs from the estate.
Right, and that's the whole thing. You gotta
Distribute.
Yep.
And that's the sad thing. You know, when somebody becomes the executor of an estate, they don't know what to do. And sometimes they just keep these estates open like it's a shelf. It's really a shelf you don't want to be on. You want to distribute the money, because when you distribute the money, it goes to the heirs of the estate at their lower tax rate. You pay like 37% if your taxable income on the estate's like $16,000.
12.
Is it 12?
It's 12,000.
So I mean, that's murder. So you want to make sure that you distribute. If you are the executor of an estate, you distribute that money so you can put them on K1s.
The thing is, for those who are listening, the elder people out there, for people out there who have elder parents, sit down and talk to your parents. Do they have everything updated? Do they have beneficiaries listed on everything? Where is their money? Have a folder, if
true.
you're the parent out there right now, of everything in there. No one likes talking about death, but unfortunately, it's one of those things that happens in life.
Right.
But tell your kids, when I go, in this folder is everything you need to know.
Yep.
Have it ready to go, because how many people do we see coming in and they're pulling their hair out because they don't know what mom and dad have, or is this everything? And they
think it's rude to ask before their parents pass away. I mean, there's none of us going to get out of this world anyway, but feet first, So I think one of the nice things is to say that I heard a program on WBEN, and they were talking about estates and elder planning, and I would just can we sit down and talk about, do you have a will? Do you have beneficiaries on your IRAs
Should you do
and
a
your
life estate?
annuities? Do you have a list of what all your assets are? And the other thing is, as people age, sometimes they get dementia. So what happens is, if you wait too long, your parents may still be alive, but they may not remember where everything is or what everything is. And so this is a conversation that I can't encourage you enough to do with your parents. And by the way, I do it every year, so that upon my death, my kids will know where everything is, because it's a terrible thing to have lost funds that the state of New York finds because nobody knows how it even got there, because nobody knows where the funds are. So you want to make sure you have that conversation. Well, we went round the block on that, didn't we?
Yeah.
I got George, EG Tax. It just makes me mad that I can't deduct my taxes on my personal home or my vacation home. When I bought them, they were deductible. And now they changed the rules of the game. I'm stuck. Any suggestions to maximize my write-off? I can't help it that New York State is where I'm making my living. Well, really, the SALT is a federal law, and New York State has retained the law of last year. So,
but the truth is, the federal government said that we're not going to subsidize high tax states, and that's why the SALT deduction's in there. The federal government meant to penalize people in high income states.
Yeah,
and it is
they
true
did.
that New York State said you can you can deduct them on the New York State return. But the big enchilada is the federal. And I understand the frustration. It broke my heart many times this year when I saw people come in, maybe husband and wife who had New York State withholding of $8,000 or $9,000, and their property taxes were $12,000, and you knew they were going to get shafted by $10,000 itemized deduction.
I think, Esther, the thing that made me most upset is I did a lot of people who were not married and who owned houses, and they were itemizing and itemizing and itemizing this year. But a married couple would get the shaft because under the SALT they get $10,000 collectively, and so
but a single person gets $10,000
individually.
right?
So like if Chris was single, he would get $10,000 under SALT, and I would get $10,000 under SALT. But because of the SALT rule for a married couple, he gets $5,000 and I get $5,000. I don't see the equality in that.
Of course, there isn't.
Right.
And I'm assuming that as time goes on here, they're going to modify some of this stuff because it isn't fair. And I understand this guy's frustration, but there is a light at the end of the tunnel because didn't he say he's got a second home?
He does.
And if he turned that second home into income producing,
rental.
who would be able to get all of his property taxes? He would. Who could get the repairs? He could. How about the insurance? He could. How about the interest? He could. How about travel down to take care of the property? He could. So if he turned it into not a vacation rental, but into a rental property that occasionally he used for personal use, then it would be completely deductible, and the SALT wouldn't bother him so much on the federal.
That is such very good planning.
Right?
Yes.
And a lot of people, say, no, I don't want to rent out my house. That's up to them. But there are people that will rent it out, and as long as they're renting it at fair market value, they get to take all those expenses. Because it's still deductible 100% if it's business and rental properties business. Plus, they could get the QBI.
Right. That's right. Absolutely, which is a new credit, and that's where you can deduct 20% of the net profit if you have a profit motive, if you're conducting your rental as with a business mindset and forum, not only mindset, but you have to do separate books, and QBI is a really, really good option.
Right, so that would be an option to them. So I guess we haven't had to think like this because tax rates were so low and things were pretty liberal. There was all these credits, but under tax reform, those people living in New York State who are kind of getting hit on the head with the hammer, they need to start thinking about how can I reduce my tax liability. God knows in New York State you're paying the long dollar.
Yeah, I had so many clients who, tongue in cheek, they would say to me, I'm leaving the state. This is it. This is the final straw. I'm leaving the state.
I had people say that, but it wasn't tongue in cheek. Right? Okay.
Esther, what's your opinion on taking my Social Security at 70 instead of 66? I have no life insurance, and I'm thinking of my wife. I respect your wisdom, Jay.
Okay, so when you just put a pencil to the numbers, it takes 15 years to equal. You'd have to live to 85 to equal what you didn't take in Social Security if you wait till 70. So it is true that you're going to get a lot more. You're going to get 8% more for each year that you wait past 66 to collect your Social Security. But if you just do the math, you're going to find out that you actually have more money left on the table if you should pass away. That's that terrible thought during that 15-year period.
Well, how about this? He says he has no life insurance. If he were to get $24,000 a year in Social Security, $24,000 times 4 years is $96,000. That's a pretty good life insurance policy.
That
in
is
the
true,
bank.
too.
Yeah.
True.
Because heaven forbid
But
he pass
everybody
away.
thinks they're going to live forever,
They're
and
so
that's the reality. But if you really take a look at it, I've said to people, at 66, you're still younger. You still are doing things. You might want to pay off your home if you don't need that money. It's about 15 years to break out even. So that's between you and your wife and your financial planner, but put a pencil to it, and you're going to find that that's
Yeah,
the case.
because-
I'm Esther Gulius, the tax lady from EG Tax. We're going to take a short break. We'll be back on the other side. Hi, I'm Esther Gulius, the tax lady from EG Tax, and this is our time to kind of chew up emails. We're not taking live phone-ins today. We will next week. I'm joined in studio with Tiffany Fabian, Christopher Fabian, and we just love this. I love this. I get to kind of editorialize and I think get into a deeper state of taxes and really help people doing these emails. We got anything left here?
Norman from Cheektowaga says, tax lady, hey, nice digs you guys moved into. I had my taxes done by you for the first time this year, and I was very pleased, but I need to correct my W-4 because I owed money, and I don't want this to happen again next year. What should I do?
Well, they're coming out with the new W-4, which is akin to doing your tax return all over again. The important thing is, if you give us a call, there's no charge. You're our client. We will help you to fill out your W-4 on the federal. We'll help you with the New York State withholding to make sure that it's accurate. So the important thing is to just call us, and there's no charge to
Yeah,
help you with
and
it.
he might want to increase his 403B or his 401k contribution. It's just shuffling around money, and the truth is, when you do that, you're saving for your retirement and your pension, and your employer probably matches something. So you might want to do hand in hand, switch your withholdings, and also put more into your 401k or 403B, because that'll reduce the
That's true.
taxability
That money's off the table.
That's right.
I will tell you, I have some clients that have the 403B and the other New
HSA.
York, and they actually are sheltering like $48,000
Right.
worth of income.
Right.
It's remarkable.
Yeah, put some money
And
into
so
an
what's
HSA.
left, and then they get an earned income credit. I mean,
Right.
So some people are just really good at planning, but if you don't know about the plan, you can't plan.
That's exactly right. That's
Yeah,
exactly
Chris.
right.
You know, going, because I'm sure you owed this year because of the change of the withholding tables
Right.
and all that. But how many of our clients, used to get $5,000 back and now they get $2,000? And one of the first things after you're done with, well, how do I get a bigger refund? And I'll say, well, change
We'll
your
send it in.
change your withholding, and have them take more money out of your paycheck. And they're like, but why would I do that?
It's what they're used
Because
to.
that's what they're used to getting that. But it's took this for a lot of people to realize
We
that
like to have the extra
We
money.
like
Right.
to have that extra. That was my money during the year that I got.
Yep.
And so a lot of them aren't going to change their
Mindset,
withholdings
right.
because they still have the refunds.
Right.
And they're okay with that. But it's real how this took for people for that to click in their
Right.
head.
Absolutely. Of course, we've been preaching that. We've
Oh,
been
I know.
preaching that song to the choir a long time. All right, what do we got?
Michael, unless you got one, Chris, go do Sam.
Stan writes in, do dental implants count as a medical expense, or is that considered cosmetic surgery?
No,
They count.
those are tax deductible.
Yep.
And they're pretty expensive. But as someone who is the recipient of dental implants, it's like helping God giving your teeth back. It's
Right.
remarkable, and
Right.
it is deductible. It is
And
a potentially deductible medical expense, provided it exceeds 7.5%. 10% of your adjusted
Yeah,
gross
but if
income
he
this
did
year.
it in 2018 and he missed the deduction, I entertain you to give us a call and see if it would have helped you, and we'll amend your return. Because, if you're doing medical, you want to also then put all your co-pays for your prescriptions. If
Your
you
glasses.
have to open up your checkbook and pay for any health insurance, your glasses, your physical therapy, your therapist, all that is icing on the cake.
Yep.
And so you really want to run your numbers, and maybe it won't help you on this federal, but maybe it will on New York. And so you want to pay attention.
Correct.
But the answer is
Correct.
yes. So
Okay.
should I do Michael from Hamburg?
Yes.
EG Tax. I'm an outside salesperson who receives no reimbursements from my employer for the travel I do. Last year, I traveled approximately 25,000 miles for business. I used to always get a deduction for my office and home, too. This year, my refund went down from $3,000 on the federal. My salary is approximately $90,000. Is there something I can do to better protect myself from taxes? Michael Hamburg.
Well, the thing is, and this is what I said to all my outside sales people, you got to go in and talk. And I would love to talk to these employers. And really, if Michael's employer understood that Michael's spending about $10,000 a year in travel, okay? If the employer says, Michael, you know what, I'm going to give you an $80,000 salary and I'm going to reimburse you when you give me an accounting of your mileage at the standard mileage rate, and that's about $10,000. The employer's still giving him 90. Michael's still getting 90, but he's only going to have to pay taxes on 80. He's going to have to pay FICA on 80, and he'll make out much better. It's a simple thing. They have to go to an accountable plan and adjust the salary accordingly. Would you agree with that, Michael?
I would agree. I mean, it's hard to get employers to change, but that would be one of the best things to do.
I mean, the guy would save $1,530 in FICA alone.
Yep.
You know, he'd still get the same amount of money, and he would save let's say about $10,000 at 20%, so he'd save about $2,000 in taxes, $1,530 in FICA. He's going to save like $500 in New York State taxes. What's not to like about this plan?
Sounds like a
But
good
nobody
plan.
wants to do it.
Right. Yeah. But I did have a few clients who their employer did it, and I was so kudos to them, you know.
Okay, what else
John
we got?
writes, my company is offering a FSA for childcare. Is that better than taking the credit on my return? And so I would like to chime in and say, you know, there's a lot to go through, and probably it is. I did have a client this year, though, who set around $5,000 away, and then his child care provider refused to give him the Social Security number, and it didn't go to a place that had a tax ID number. So you really want to run the numbers and ask the question, as John is doing.
Well, you know, if
then
ever
it was
there was a
added.
group of people who are getting away with murder, it's daycare providers that are doing it in their home because they always refuse.
Yes.
And the parents who desperately want quality daycare are afraid to tick off the daycare provider. You know, one of these days, these daycare providers, remember when they started auditing waitresses and their tips?
Yeah.
And then everybody was all upset. One of these days, the IRS is going to audit people that are doing daycares, and they're going to
they
be
should.
very, very sad that they haven't reported the income, because there's so many deductions available to a daycare provider. You can write off a large percentage of your home, your utilities, you get to
Food.
take depreciation, food, travel,
phone.
toys. I mean, all of this. And so the daycare provider actually pays very little in taxes. So it's right now it's a lose-lose situation, but it could be win-win.
Right. Now what, let's say they go to like Doodle Bugs.
Well, Doodlebugs is good.
Yes. And
But
so
the
then they'd
difference
have tax.
between a professional daycare establishment is usually they're far more rigid in their rules. Like, for instance, if you're 10 minutes late, don't they give you a penalty?
Oh, yeah, you pay a ton of money.
Right. So,
Yeah.
so that's where I think a lot of people like that they can go to Stella up the street, who says, "Oh, it's okay. You know, I got Johnny here." But the trade-off is that Stella says, "Oh, I'm not giving you my Social Security number."
And thinking about Stella, I've been doing this for a long time. And New York State, if you take the child independent care credit for the state, if you give Stella cash, it's not going to work. You have to
not if they audit you.
Not if
That's for
they
sure.
have. You have to have checks, and you have to have checks to back it
And
up.
Stella's you got to have Stella's Social Security number,
Right,
right?
Chris, you've been
You know,
wanting to say something.
doing the math, if you're in the 22% bracket, okay, you have 22% federal tax, 7.65%
New York.
Social Security, and 7% New York. We're keeping it. So figure about 37% between that you would save in tax dollars because it's coming out of your paycheck before taxes to
Right.
put into the FSA.
You mean if you're using the FSA?
If you're using the FSA. If you're just going to use the credit, you're going to get a 20% credit on the federal, and probably which is the maximum of we'll say $1,200, and then New York State you get maybe a 20% credit of the $1,200, so another $200. So you're saving maybe 22%.
Right.
I'll save 37% over 22%. Do the FSA.
Right. Oh, okay. So
I'm doing the physical math.
Right.
It's better in your pocket.
It is better.
As long as everything
As
is
long
done
as you're
right.
using
Right.
it.
Yep.
Right. But before you, when you're looking for that daycare provider,
And then make sure
the first thing you should say is, will you give me your, I mean, obviously there have to be qualified daycare providers who are not tax cheats.
right.
There has to be.
Absolutely.
You know.
And then also this person that I was just referring to, his wife didn't work. And so you're not entitled the credit if the other person isn't working or disabled.
Unless she's disabled or going to college.
College,
So
exactly.
if you're working and your spouse is in college or disabled, then you're also entitled to take the child and dependent care credit. And remember, it's child and dependent care credit because let's say you do have a disabled spouse. You can pay for daycare for your disabled spouse and take it as a credit on the federal and state as well.
Yep. I have one more quick question.
gotta be fast.
Esther, my father gave me stock when I was 10, and now I want to give the same stock to my son who is 10. Is there any tax issues that I need to worry about, Ben?
Well, the basis is all I can think of is what did it cost originally? What were the reinvested dividends? Because somebody at some point in time, if it only could go through the estate, would get a stepped up basis. So I don't know, gifting it would be a good idea. Maybe the better thing to do is leave it through your will so that your grandchild, your child, who would be the grandchild, would get the stepped up basis, or that's what but anyway, we're running out of time. I'm Esther Gullius, the tax lady from EG Tax with Tiffany Fabian, Christopher Fabian. If you need the best tax help, we're there to help you all year long. Our corporate headquarters at 1890 Colvin is open 9 to 5 Monday through Friday. And if you need us over the internet, it's egtax.com. Have a great day. Bye-bye.